And good afternoon. Welcome into Market Talk for Tuesday, February 2nd, 2021. I'm your host, Jesse Allen. Great to have you here with us. MarketTalkAg.com. That's our home on the web. MarketTalkAg.com. That's where you can find us. Facebook, Twitter, Instagram as well. It's all at Market Talk Ag. Great to have you with us here for another program here today as we get into the month of February and a down day in the grains today. Livestock took advantage, though, traded higher. Let's talk about all of it. We'll bring in our good friend Brian Splitt with agmarket.net joining us today. Brian, how are you?
Good, Jesse. Thanks for having me.
Hey, I appreciate you joining us today, Brian. And let's just start overall looking at this grain market, kind of the same story as we saw on Monday, just starting with some weakness, maybe a little technical selling, funds doing a little correcting of this market. It seems like not quite as good of a close today as it was yesterday. We did rally back a little bit on Monday, but today we stayed off the lows, but we finished moderately lower. What are you seeing overall in this grain market? What's the reason for this weakness to start the new month?
Well, we've got a couple things going on right now. I think the anticipation of the Brazilian soybean crop is putting some pressure on soybeans, and the idea there being that we are likely nearing the end of the major buying spree. That doesn't mean that we have a whole lot of soybeans left, and that we're likely to see our domestic stocks tighten up further on paper as we approach the February WASDE report. But we're probably entering that period where the Chinese are going to slow down their purchases of U.S. soybeans. They're going to focus on Brazilian soybeans. That probably means good things for corn, though. We've been shipping a lot of soybeans, and now the focus will turn from shipping soybeans to shipping corn. And we do expect that we're going to start to see the purchases focus more on corn than soybeans at this point. Beyond that, we do have the dollar index has been carrying a very large spec short position. We did see the dollar index take out some short-term resistance today. That will probably lead to a little bit more short covering. Potential target on the dollar, maybe a retest of the 93 area. We are still looking at the dollar trending lower in the big picture, so that might be more of a short-term, short covering move, and that could put a little pressure on things. But the funds are very long. They're very long in grain. They are susceptible to big profit-taking events. But look at corn, for example, today. Doesn't feel good that it's down 5 or 6 cents, but it was an inside bar from yesterday. So today's high was below yesterday's high. Today's low is above yesterday's low. So we really didn't do anything on the chart today. And yesterday was the highest settlement for March corn. So it's hard to say, well, this was a bad day. It was just a little bit of profit taking. You're going to have to start taking out some kind of support to be a little bit more concerned about it. And frankly, I wouldn't be surprised to see corn maybe dip back down and retest that gap area one more time. When we had that January report, we were limit up. We gapped higher that night. And so now we've got another report coming up, and I wouldn't be surprised if we retested the scene of the crime one more time before those numbers come out. So we'll see how it pans out in the next few days.
Yeah, that report coming up 1 week from today, specifically on corn. And we talk about China, that Chinese demand we saw last week was just crazy. It seems like it's insatiable for the Chinese right now to buy corn from the U.S. And then we come in here yesterday and today, and we don't see any Chinese sales on the Daily Wire, but I know the rumors are still out there, Brian. And we look at this corn market with this Chinese demand. To me, it seems like the corn market is a lot more friendly right now than the bean market to maybe get some bullish momentum back into it. And I think a lot of producers in the countryside are maybe happy about that because there's definitely more corn out there than there is soybeans right now.
Well, right. And I think, what we kind of talked about there about the export program really shifting to corn from soybeans has a lot to do with the relative strength of corn to soybeans. But producers have a lot more corn bushels. They grow more corn than they do soybeans. It's just the amount of bushels that they produce. So I think with the move that we've already seen in soybeans, it would be welcome for corn to take a leadership role over the next few months.
Now, one thing I did see with corn today, and I saw it yesterday as well, that I thought was a good positive note, it seems like those new crop contracts, I saw the September contract ended up finishing unchanged on Tuesday. So it's nice to see those contracts rally even a little bit more than the front months did, Brian?
So you could see that as positive. Some would see it as negative. I think the negative aspect of it would be that they're unwinding bull spreads. So as the market has been rallying, we've been seeing the funds buy the old crop and sell the new crop as a spread. We've saw, March gain on May, May gain on July, all old crop gaining on new crop. So yesterday, the fact that new crop came back to finish at a much better level relative to the old crop is, I think, a lot of that is the profit taking on some of these spreads. And so as they do that, they're going to sell the front and buy the back, which will make that new crop perform a little bit better. But in the general grand scheme of things, if that is going to be a feature that we see stick around for a while, bear spreading, that does not bode well for the big picture. I tend to think it's more kind of short-term profit taking as we get geared up for this report next week. As long as the flat price futures aren't taking out any good horizontal support, I think the uptrend is still very well intact.
Well, and looking ahead to that report as well next week, I'd love your thoughts on what you guys are seeing there at agmarket.net. We're hearing more about how we got to, continue to shrink this carryout number for soybeans, and even so with corn as well. Some people are thinking that number is going to need to get smaller just with all the demand we're seeing. What are some things that you and the team at agmarket.net are seeing ahead of this report that we can maybe watch out for going into next Tuesday?
Well, I would say the first thing that you want to watch out for is when the pre-report estimates hit the news wires. So that'll be Bloomberg and Reuters, and they survey the different analyst firms, so agmarket.net being one of them, and then all of the other brokerage houses or analyst firms in the industry will put their estimates out. And in the last several months, we have seen a few examples of where those estimates come out and they're friendly, and then the market trades those estimates almost like it's a report. So we'll see what happens if the average trade estimate for soybean ending stocks comes in. Last month the USDA had it at 140 million bushels. Let's say the average estimate is 120 or 125. I think it's going to be hard for the trade to ignore that, especially with us sitting here, 80 plus cents off of contract highs on soybeans right now. And we've got the export commitments to, I think, warrant the USDA increasing the export demand on paper. Whether they do or not, who knows? They don't have to. They don't have to do anything if they don't want to. But we feel that we've got enough on the books right now to warrant an increase in export demand on paper. And then that goes for corn as well. When you look at what the USDA did with corn on the January report, in order to accommodate the lower production number with the drop in yield, they dropped corn for export, they dropped corn for ethanol, and they dropped the feed residual number. I think we could look at the exports and say, okay, well, they dropped that 100 million. And since then, we've seen China come in, and like you said, they've been very aggressive buying. So the USDA may need to walk that back and say, well, we're not rationing demand. And I think the amount of Chinese corn purchases proves that we are not rationing demand at $5.30, $5.50 old crop corn.
Well, and I've heard from a lot of producers as well, and we'll talk about this before we move over to livestock. Some guys and gals are still holding on to sizable amounts of old crop corn in the bin. Really not much for soybeans out there. I've heard of a few people who are just kind of, playing with some wild card bushels that are in their bin right now. But if I'm sitting on any old crop corn left here as we head into this report and we look at where price levels are at, what would be your recommendation or advice to some of these producers right now? Should they continue to watch and wait to see if we start trading some of those pre-report estimate numbers and pop this market a little higher? Or if it makes sense for them to move some bushels right now, should they do it?
Well, there's several different ways to attack this question. I think if the producer wants to hold their physical bushels thinking that they want to make the play for the summer market, then they probably need to do one of two things. Either mentally have an area below the market where you say, if we get below this, I'm going to let some bushels go. So almost a mental sell stop where you tell yourself, I'm not going to take any less than a certain amount. Or you say, we're at good prices. Maybe I should just have a put under the market for this report just in case. The alternative is to say, all right, well, we've got some strong basis. We've seen the market go up substantially. We're at extremely profitable levels. So maybe I'm going to go ahead and make some sales, and then I'll go ahead and take a portion of that sale. Maybe it's 20 cents, 25 cents, and just go out to July and buy some kind of a call position. And that way, if we do see the market make some higher highs as we go into summer or through summer, you're still in a position to take part in that move on paper with a limited defined risk. So I think we've probably discussed three different ideas, and which one the producer decides to do probably has a lot to do with whether they're willing to sell physical bushels right now or not. I get the sense that most producers are in the mindset, if we're at these prices right now, then what kind of prices could we see as we approach summertime? I get it, but again, at the same time, when you look at what happened a year ago, the rug could get pulled out from us at any given time, and it may have nothing to do with the corn or soybean balance sheets. It could have something to do with another black swan event, and maybe it's another black swan with COVID with these new strains. Who knows, right? But I think what you don't want to do is just assume that the market's going to keep going up and ignore it. You should have some kind of a strategy in place, whether it's a mental strategy or a put or sell cash and buy a call that allows you to take advantage of the rally, but still participate if the rally keeps going.
Well, Brian, great advice there. Let's move over to livestock and cattle, hogs traded nicely higher here today. Probably piggybacking off some of those lower grain numbers. And, we saw lower closes Friday, a little bit hesitant trade on Monday. Maybe, we were correcting some of our overbought positions here. And looking at this market, I think first with hogs, that seemed to be where the most strength was at today. I know some folks have been a little bit hesitant with this hog market overall with COVID and demand issues domestically and things like that. But a good day in hogs today. Anything you're seeing there that we can get excited about?
Well, I have been excited about hogs, and now my excitement is I'm not excited anymore, and simply just because we hit a major upside objective. So the April lean hog contract had a head and shoulder bottom, and that projected to roughly 78 was the upside target. And so we did trade a little bit above 78 today. We've been in what I would say is an upward trending channel. We had some major highs several months ago. We had another major peak a couple months ago. So if you look at that as an overhead channel line, these highs up in the 78 area are now butting up against that overhead channel line. So as we've kind of reached the target of the head and shoulder bottom, and as we're butting up against this overhead channel line, I don't know that means I think it's going to go down, but I think to me in this rally, the rally that I've expected has been made. Does that mean it's going to stop and turn around and go down? No, not necessarily. But I do think that with the objective of the head and shoulder bottom being made, with us butting up against the overhead channel line, if I'm a hog producer, I might use this as an opportunity to look at some puts and maybe have some put coverage under some of my production for our spring and early summer time frame.
Well, and Brian, it really seems like on hogs, that pork cutout has really been a good support underneath this market here as of late.
Yeah, pork cutout this morning. We had some good news this morning. I don't doubt that had a lot to do with the sharply higher gains we saw in futures today.
Well, let's switch over to cattle. And I know this feeder cattle market did really well today with the drop in corn prices. Live cattle wasn't too far behind. We saw some higher trade in feedlot country last week, and sounding like we might have feedlots throw out some even higher bids here this week. Beef cutouts continue to be strong. What are you seeing in this cattle market right now that we could maybe get excited about? Because we've been fairly range bound for the last few months, but it seems like we're trying to maybe push this market just ever so slightly higher.
Right. So the nearby contract February live cattle has been in a very, very sideways range, and you could probably go all the way back to mid-July, I believe, that we've been in this trading range. But it does seem like some of these deferred contracts were able to break out to the upside. A couple months ago, the April contract got on board not too long ago. I don't know if February is going to really try to push to the upside or not. I think if we could get above this 116.50 on Feb and stay above it for a few days, show some bids above that level, then the market could have some upside into expiration. With cash right now, we're looking for some 115 to trade. I think if it does trade, then the futures might try to step it up a notch and see if the futures follow. But I think some of the optimism on the feeder cattle side, it has a lot to do with these deferred live cattle contracts. And with these contracts in a nice uptrend, we're holding some of the support that was resistance as far as previous contract highs. So as these deferred live cattle contracts continue to push, I think that gives the feeder a little bit of optimism that they can pay up for these levels on feeder cattle prices, looking for the live cattle down the road to be worth more.
Well, Brian, you mentioned the dollar earlier, and we look at the outside market, stock market, starting to get some strength back into it. Any thoughts there that we might see affect our markets here moving forward this week?
Well, I think the dollar, that's going to probably have an effect on wheat as far as between corn, soybeans, and wheat, which one's going to be the most sensitive to dollar movement. I think it'll be wheat. As far as, the stock market movement affecting the grain and commodity prices in general, I don't know that there's much of a day-to-day correlation. I think the biggest thing that you just need to watch out for in the stock market is if there's a major liquidation event, similar to what we saw last spring. And again, that was due to COVID. But when you have the stock market dropping precipitously like that, and those losses need to be paid for somehow. And so generally your fund managers are going to be reducing all position sizes. If the stock market's going to stay positive and maybe make some new highs, that's probably a good thing for the live cattle, especially as we're looking at the idea of opening up a little bit more, seeing more restaurant demand, heading into summer, grilling demand. But as far as the stock market providing a major effect on commodities, as long as we're not, really hitting the skids and seeing extreme liquidation like we saw when COVID really started globally, I don't see the stock market having that big of an influence.
Well, Brian, always great insight into the market trade. We appreciate it as always. I know folks can reach out to you and the team at agmarket.net. They can go right there to the website, agmarket.net. They can download your app or, just give you guys a call and work through any questions they may have.
Right. So 844-4AG-MARKET. So that's 844-424-6758. You mentioned the website, www.agmarket.net. The app can be looked at a 2-week free trial at agmarket.app.
Well, we appreciate the time as always, Brian. Thanks so much for joining us on this Tuesday and have a great rest of your week.
You too, Jesse. Thank you.
Brian Splitt with agmarket.net, our guest today here on Market Talk. That'll do it for the Tuesday, February 2nd edition of the show. Find us online, markettalkag.com. I'm your host, Jesse Allen. Have a great afternoon.